Welcome to this explainer, breaking down week 25 of the gold mining Guardian journey. We're diving straight into a totally transparent analysis of a live, automated trading system. But we aren't just skimming the top-line numbers. We're analyzing this through the lens of institutional-grade data pulled straight from MetaTrader 5. Our big focus today? The often misunderstood reality of live markets, floating drawdown. We're going to look at exactly how a multi-currency algorithmic strategy weathers some pretty intense macroeconomic turbulence. To really set the stage, we have to talk about 84.55%. That is our total growth metric so far, and it totally anchors this long-term journey. Now, what's absolutely crucial to remember here is that this isn't some massive corporate fund. It's a real money cent account. We started this with exactly 2,500 cents, literally just $25. And through steady, calculated automation, the current balance is sitting at over 4,519 cents. It's a systematic climb. But as we all know, the market doesn't just go up in a straight line.
Because this week we really had to confront the reality of live trading. The core story for week 25 is basically this. Our growth absolutely continued, but the floating drawdown is rising. Our algorithmic strategy successfully secured realized gains, which is great, but at the exact same time, our unrealized equity temporarily weakened against a backdrop of really heavy global volatility. It's that classic push and pull of algorithmic trading that honestly rarely gets talked about openly.
Now, to understand how we navigate that turbulence, you have to look at the structure of the strategy itself. By tracking this real RoboForex cent account, we can decode its multi-major approach. We did experience a 1.74% weekly floating drawdown, but splitting our exposure across four distinct majors, EURUSD, USDJPY, USDCAD, and USDCHF, is exactly how this system acts like a shock absorber. When macro turbulence hits, relying on just a single currency pair, yeah, that's incredibly risky. Before we get into the heavy turbulence, let's look at what the system actually banked. The algorithm systematically executed 28 trades this week to lock in a really solid weekly profit of 73.04 cents. When you put that in the context of our overall balance, it added a very respectable 1.64% increase to our realized funds. Plus, the profit factor for the week stood at a robust 2.50. So, purely looking at realized gains, the system did exactly what it was programmed to do.
But to understand the true health of the account, we have to dig a bit deeper. We really need to analyze the divergence between these locked-in, realized gains and our fluctuating open positions, the floating drawdown. You know, it's super easy to just look at a rising account balance and assume everything is perfect. But automated systems constantly have to hold temporary negative positions while waiting for the market to cycle back.
This divergence perfectly illustrates that exact concept. The realized balance remains incredibly stable, actually ticking upwards slightly as those 28 trades close in profit. But the equity curve, which represents the real-time value of the account if we just panicked and closed all open trades immediately, takes a really sharp drop starting around June 18th. So the balance is completely safe, but the open trades are temporarily sitting in the red.
And that visual separation is floating drawdown in a nutshell. I want to be super clear here. Floating drawdown is an entirely normal, completely necessary operating state for algorithmic systems. When you're navigating choppy market waters, a grid-based or averaging system literally needs room to breathe. It scales into positions as the market moves against it, fully expecting a standard mathematical retracement to eventually clear those trades in profit.
So what actually caused that equity drop? Well, let's dive into the macroeconomic drivers, starting with the euro versus the US dollar. During week 25, shifting expectations around Federal Reserve interest rates, combined with European Central Bank policy developments, created these really sudden, sharp downtrends. The algorithm had to manage complex grids, scaling into the drops and absorbing the pressure as the euro weakened against a very resilient dollar.
Moving over to the USJPY pair really builds out this macro picture. The story here was completely different. The algorithm was executing sequential trades into a massive upward trend. This wasn't a sudden drop at all. It was aggressive momentum fueled by Bank of Japan policy expectations, keeping the yen historically weak, while the US dollar just dominated. The algorithm had to carefully step its way up this mountain without over-leveraging the account.
And that global volatility extended right into the commodity currencies too. On the USDCAD pair, we saw more of that aggressive upward momentum. A lot of this was driven by shifting sentiment in global oil markets, which obviously heavily impacts the Canadian economy, layered right on top of that broad US dollar strength we were just talking about. The system was basically forced to deploy its upper grids to maintain control.
Finally, we look at the US dollar versus the Swiss franc. Now, the Swiss franc is traditionally your classic safe haven asset. In week 25, accelerated safe haven flows heavily impacted this pair, creating these rapid whipsaw movements across the charts. The algorithm was literally catching the bottom of a steep drop and then immediately having to navigate a sharp vertical climb. These are incredibly complex market dynamics, all happening at the exact same time.
So, this brings us to the absolutely crucial question. How does an automated strategy survive this level of concurrent macro turbulence without just blowing up? I mean, with central banks, oil prices, and global safe haven sentiment pulling 4 major currencies in completely extreme directions all at once, an account like this doesn't survive by getting lucky. Its survival relies entirely on its structural design.
And the answer to that is automated diversification. By splitting our exposure across 4 distinct currency pairs, a temporary weakness or high drawdown in one symbol is frequently offset by the stability or even the profit of another. You can see this distribution in the weekly data. Over the long haul, EURUSD usually carries the bulk of the weight, but in week 25, trades were way more evenly distributed. USDCAD, USDJPY, and EURUSD all generated identical profit factors of 2.32 for the week. The algorithm essentially leans on its strong pairs to subsidize the pairs that are temporarily caught in a macro storm.
This kind of transparency is brilliantly evident when you look at the raw MT5 deals history. You're seeing the actual fractional cent profits locking in. We're talking 3.74 cents here, 8.20 cents there. It might sound tiny, but these precise, automated executions combine to absorb negative swap fees, which totaled around 35 cents this week, and still secure a net positive 73-cent gain. And impressively, despite all that macro turbulence we discussed, the maximum deposit load for the week barely touched 2.55%. The system was never overexposed, not once.
We definitely need to keep reminding ourselves why we are tracking these micro movements in the first place. Every single cent gained and every temporary floating drawdown successfully managed is a highly calculated step toward our ultimate target. We're marching toward 10,000 cents, which is roughly $100. This explainer isn't about some get-rich-quick scheme. It's about validating a long-term process.
Look, enduring a floating drawdown, watching your real-time equity dip is psychologically really tough, even on a cent account. But it requires trusting the mathematical parameters of your risk management rather than making emotional, manual interventions. If the algorithm is designed to hold a maximum drawdown load, you just have to let it execute its recovery logic. Patience over panic. That's for sure what separates a blown account from a growing one.
Zooming out to the macro view, the total equity growth curve really puts the whole thing into perspective. Yes, right at the end there, you can clearly see that recent sharp dip in equity that we've been breaking down. But look at the entire picture since January. The foundational trajectory of this carefully managed cent account remains resolutely upward. That 84.55% total growth, it was not achieved in a straight line. It was earned by mathematically surviving dozens of these exact types of temporary drawdown events.
So, as we close out our analysis of week 25, I want to leave you with a final thought to apply to your own systems. When market volatility inevitably spikes, whether that's from a central bank announcement or a sudden shift in global sentiment, and your account equity takes a dip, is your strategy going to act as a shock absorber or a point of failure? Truly understanding floating drawdown and planning for it through diversification and strict deposit load management is the real secret on the journey to long-term growth. Thanks for joining me on this explainer, and keep your eyes on the data.